Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning, hello, and welcome to Bazaar Morning Call. We're coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Surabhi Upadhyay. With me, as always, Nigel D'Souza, and Rima is keeping us company through the week. And guys, what a roller coaster we've had, right? But I want to start with a bit of optimism, because you remember before closing bell yesterday, we started noticing the fall in US futures and the fact that this whole Trump commentary is scaring markets. So I don't know. I mean, I'd like to believe that we've kind of preempted the global fall.
Well, that's right. But when you wake up to the US markets losing more than $1.5 trillion overnight, whoopsie daisy. That's telling you that the US markets are under pressure. But I take that point. Maybe the Indian markets preempted something. And I guess, this is the time not to be very, very brave, but not to be silly and throw in the towel. I think that's going to be important.
Wise words.
Indeed.
Morning, Rima.
Hi, good morning. So, red day or not a red day?
He's wearing maroon. Fence it off.
I think it'll be a little less red by the time we wind up, but that's the optimist in me speaking. So let's see how it goes.
Okay, so let's get started. Lots and lots of cues to track and plenty of headlines. I mean, in overnight action, so much going on. So let me dive straight into it. The question that the street is asking and that global market participants are asking is that is the US manufacturing a tariff-induced recession? That, in essence, was the one line that was playing out on market participants' mind, and that is why we had this big sell-off. So what have we seen? We've seen about a 2 to 4% collapse on U.S. indices. The Nasdaq took it on the chin, down about 4%. And it's not just, equities. We saw that risk aversion play out in bonds and cryptos. I'll come to all of that in just a minute. But yes, tech is where the troubles really were paramount. So you had big stocks, Apple, Meta, the likes. All of them were down between 4.5% to 5.5%. But again, it wasn't just a tech-centric sell-off, because even the Dow and S&P 500 sold off. Big U.S. banks, Wells Fargo, JP Morgan, Bank of America, these stocks were down between 4 and 6%. The concern is the U.S. grinding itself into not just a slow growth patch, but a recession? So just going back to where it all originated, now Mr. Donald Trump was on Fox News on Sunday. Actually, our market started reacting to this last afternoon, which is why I'm saying, have we preempted the fall? And in that interview, he was asked whether the U.S. recession is a possibility, and he didn't outright deny it. He didn't blast it off as a nonsense idea in his trademark style. He actually said that the U.S. economy is going through a transition. And the fact that the U.S. president was very matter of fact about it is what scared the market. Because this market till now has been working on the belief or the premise that the US president will do whatever it takes to keep Wall Street, soaring. And now that's coming under a bit of a cloud. So let's talk about the other asset classes. Equities we've discussed. Yields were down about 9 to 10 basis points, the US 10-year and the 2-year. There was a flight to safety. People were moving to bonds. The US 10-year yield, in fact, last I checked, was about 4.1%. Yeah, still below the 4.2% mark. 4.16 was the low. Now it's at 4.18. As we speak, the dollar anyway has been faltering. And even yesterday, the levels were on the DXY, they were largely below 104. And again, that flight to safety means a move towards the yen. Yesterday, the dollar fell almost 0.75% to the yen. 146.6 was the session low yesterday for the dollar, as the yen continued to soar higher and higher. This morning, sort of slightly off that mark. But anyway, the yen and the Swiss franc is where the money has been moving as the dollar continues to be under pressure. Then move on. Cryptocurrencies, they weren't spared either. The slide was between 6 to 14%. Many of the other Bitcoin was down about 6-7%. Ether, Solana, these currencies were down between 12% and 14%. The Bitcoin is now at November lows, November 24 lows, falling below the 80,000 mark. So that's what was playing out in cryptos. Oil was part of this whole global sell-off as well. About a 1% decline. Brent is below $69 a barrel last I checked, which is a good cue for India, actually. It's a very, very positive cue. But that's how it was playing out. Now, it's a very data-heavy week for Wall Street, so we have to keep our ear to the ground, and the markets are really holding their breath on a couple of numbers. First is the consumer inflation number, which will come out on Wednesday. Then the producer price index comes out on Thursday, and the consumer sentiment indicator, the University of Michigan survey, that comes out on Friday. And all these data points will actually map a more clearer picture of the U.S. economy, which is the reason behind the correction. Now, India was caught up in this global storm yesterday itself. The question really is that whether India can continue rising in the wake of bigger US troubles. Now, this is the fall in the last 1 month on the US indices. You can see the Nasdaq has really taken a big hit, down almost 11.5%. So the question is the US exceptionalism faltering? The answer is yes. But can India be a direct beneficiary of that? That is the point of debate, and we'll discuss this with our market experts as we go forward. Let's see. Maybe we start slightly soft. Asian markets have been weak as well, but maybe we'll pick up from there. Lastly, on the local front, I just want to leave one more point on the radar, and that is IndusInd Bank. In addition to all the global issues, what IndusInd Bank reported yesterday, the fact that there are accounting discrepancies in their derivatives portfolio. This is Forex derivatives, I think, that they're talking about. And that could be to the tune of almost 2.3% of their net worth. I mean, the disclosures to come in now, yesterday was about Mr. Sumant Katpalia not getting a 3-year but a 1-year extension. So it's something that makes the market nervous. It's not something that the market likes to hear of, especially in large cap blue chip stocks. That's another issue that we have to contend with. But let's see, bracing for a bit of a rocky start.
Indeed, and the amount is quite large, right? IndusInd Bank's net worth is 65,000 crore rupees. So we're talking about, 1,500 crore in terms of a discrepancy. But, the Indian markets have already fallen 15 to 20% from their peak level. Just to map up the US markets and the fall from the peak. So the Dow is down close to about 7%. The S&P 500 has closed 8.6% from its February 19th high. It's shed over $4 trillion in terms of market value from its high. And the Russell 2000, that's the small cap index. So the stock market turmoil has taken the Russell 2000 closer to bear market correction with a near 18% fall. The good thing back home is that the FI selling appears to, coming closer to exhaustion levels. So yesterday, the FI net sell was sub 500 crore rupees. The DII's net bought about 264 crore rupees. And that FI selling over the last couple of days and how it's abated will also come up for you on your screen. Now, in terms of cues to track, today is sensex weekly expiry. Levels to watch. For the last 2 days, the Nifty on an intraday basis has been taking support between 22,400 to 22,450. So the first port of support for the markets would be the range of 22,400 to 22,450. But after that, the recent swing low on the market was a level just sub the 22,000. Remember, we all said that important resistance for the markets kick in between 21,800 to 22,000, and the recent swing low will be, come up. Asia is deeply in the red following the rout on Wall Street. Nikkei is leading the losses there. Nikkei, the Japanese index, is down close to about 2%. The Q4 GDP print coming out of Japan was lower than street expectations, revised down to 2.2% versus a 2.8% prior estimate. So now all questions are being raised whether Bank of Japan can go ahead with that expected rate hiking cycle. March policy, possibly a hold, but maybe in May they could go ahead with a rate hike. And not to forget, in terms of the Trump tariffs, tomorrow the blanket 25% tariff on aluminum and steel on producers across the world comes into effect. So 12th of March, will there be a delay or will it go on as scheduled? That's up in the air.
Well, that's right. A couple of observations here. The GIFT Nifty suggesting we pull back only around 0.4%. That's 0.5% odd. I won't be surprised if it's a little bit wider in the initial ticket sell because the global markets are down between 2 to around 3%. And the other point is maybe not go in whole hog, but for a longer term investor here in India, it's actually a very, very good time, I think, so to start chipping in. Don't go in whole hog, but don't throw in the towel. That's going to be important. And as you all mentioned, yesterday it seemed we preempted that maybe, in fact, the US markets are going to have a wobbly trading session. So you put that 0.5% decline yesterday and 0.5% to start off with. Maybe we factored in some part of the bad news overnight in the initial tick itself. Let's take stock then. Let's look at a couple of pauses. We've been telling you about how dollar index has cooled off. Brent crude prices as well have stayed lower. Well, both those two are good. A couple of other positives. The net long positions on the dollar, that's come down by close to around a half. In January, the net long positions in the futures market were close to $35 billion. That's come down to sub $20 billion. So those net long positions have declined. And, it's weighed on the dollar index as well, which is good from an India market perspective. Because of the weak data prints that we have got in the last few weeks coming out of the United States, now suddenly there's that chatter of 50 to around 75 basis points cut going by various, global agencies that track this particular data point, and the Fed futures as well is indicating that maybe we start getting rate cuts. I just recall, a few weeks ago, people were talking about no rate cuts. So that's another, positive in the sense there'll be liquidity into the system. Moving to the sell numbers. The FIs, yes, they continue to remain net sellers, but now that number is sub 500 crores. In yesterday's trading session, both the institutions, in fact, the buy number from the DIs as well as the sell number from the FIs were much lower than the averages that we've seen. So it appears in yesterday's trading session, there was more or less, the weak hands that were selling into the market. It wasn't institutional-led selling that we saw in yesterday's trade. Another factor comes up for you on the screen. Yesterday, you were wondering, the March futures came down drastically from around 100 points to around 55 points, but there were no big shorts in the system. In fact, there was some unwinding of open interest out there, telling you that there were some net longs that were unbound as well. And another factor that could have played out was the FI. Well, on the stock futures, they have been net long, but in yesterday's trading session, they unbound more than 20,000 long contracts, which could have weighed on the markets as well. Moving to how are they positioned? Mild shorts were added yesterday, mild unwinding in longs. Well, the short positioning continues at around 82% or thereabouts and at around 1.8 lakh contracts in absolute terms. Options data comes up for you on the screen, and that's very, very important because the call writers, they feel they're back in the game. Even in yesterday's trading session, there was aggressive writing on a couple of calls, while this put, the 22,000 put, is the most important level that you're looking at. So let's get the levels up for you on the screen. The recent low, that becomes the important support zone. And in fact, the 20-day MA, that's important at around the 22,700. So that's the range. You don't want this level to break on the downside. And with today's trade, the 22,500 odd mark will be a bit of a resistance, in fact, in case we get up and going. The Nifty Bank, well, yesterday that was a little bit subdued as well. This is a crucial support zone that we've seen. Last week, we almost went to this mark of around 47,800. So that's going to be important. That's the important support zone. Recent high becomes a bit of a resistance. So there are going to be three pillars in trade today. The Nifty IT index could be a little bit off color because what happened to the Nasdaq. So it's on to the Nifty Bank and big boy Reliance Industries. They'll have to find their form. But by the end of today, maybe, just maybe, it's not as bad as the first 60 minutes or so because the Nifty could easily be down more than 0.5%, but then don't rule out a bit of a pullback.
I think one thing is for sure, guys, that maybe they don't do it today, these FPIs, which is quickly run to a market like India. Yeah. But what's happening in the US will force people to rethink their long-only, US-only strategies. They'll go back to the old market adage that you cannot have all your eggs in one basket. And that perhaps should be a boost and a benefit for us. Anyway, let's move on and start off with the equity call of the morning. Jonathan Garner of Morgan Stanley thinks that Asia EM equities can continue to show low beta to the ongoing decline in US equities. He says they continue to emphasize domestic revenue over US exposure, which means Japan with a focus on financials, real estate, trading houses and defense, China with a focus on internet and e-commerce, domestic tech, hardware and financials, and India with a focus on financials, industrials and consumer discretionary, as well as Singapore and UAE on financials and property. He says they stay underweight Korea, Taiwan, and semiconductor and tech hardware would avoid low-quality growth as a factor. So that's Morgan Stanley. Bullish views continue on India.